Welcome to Stewardology, a podcast where two worlds collide. In this show, financial advisor Tim Russell and Reverend Drew Gysi come together to explore the intersection of financial stewardship and theology. Their unique perspectives help Christians and churches understand and apply a biblical framework for everyday financial decisions, so Christians everywhere can improve and strengthen their walk with Christ through biblical stewardship. Before we get started, we just wanted you to know that the topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. Securities and advisory services are offered through Genuous Wealth Management, member FINRA and SIPC. Without further ado, here are your hosts, Tim Russell and Drew Gysi.
I'm Tim Russell.
And I'm Pastor Drew Gysi.
And we welcome you to episode 96 of
the Stewardology Podcast. Well, Tim, to begin this episode, I'd like to take us back to a passage of Scripture that I think we've talked about a few times.
Just a couple.
Just a few times. And the passage of Scripture is the parable of the talents found in Matthew 25. Matthew 25, verses 25 through 27 says, "So I was afraid, and I went and I hid your talent in the ground. Here, you have what is yours." But his master answered him, "You wicked and slothful servant. You knew that I reap where I have not sown and gather where I have no seed. Then you ought to have invested my money with bankers, and at my coming I should have received what was my own with interest." You know, as I look at these few verses in light of our topic today, specifically speaking about interest rates, we can extract some transferable principles and understandings from these few verses. There are expectations of the steward from the owner. The master did not just expect babysitting of his resources. He expected some wise management to happen with it. And the master also expected growth from his resources put into the care of the steward. And the master was even willing to accept the minimal growth possible, bank interest, from the resources that were in the steward's care.
Yeah,
and then,
begrudgingly.
Begrudgingly, I think, yeah.
The least you could have.
The least. And the master had the right to speak into and speak harsh to the foolish servant that chose to be totally safe, and I'll go as far as unresponsible with the resources put into his care.
Yeah, he calls him a wicked and lazy servant.
Pretty harsh words.
Wicked and lazy. So you said safe, right? Trying to be safe and prudent, and the master says wicked and lazy.
Pretty hardcore.
Yeah. He didn't take the effort.
No.
To find a better option.
Yeah. So, and there is a reasonable and easily obtainable duty placed on the steward. And looking at the whole of this pericope, the steward could have done so much more with even just the simplistic aspect of basic banking.
Pericope, huh?
Pericope. You like that?
That reminds me of my college days, man.
Yes,
Pericope.
yes.
Pericope is a story. The whole, looking at this whole story, the steward could have done much, much more than just simply putting it in the bank. Hey, before we get going, I wanted to just put a quick plug in here. You may be listening to this episode and previous episodes and wondering, how am I doing? Am I doing what I need to be doing? Are there things that I just don't even know that I need to be doing? That's why we created these free stewardship reviews. If you go to our website, stewardologypodcast.com/review, you can schedule a free stewardship review with me or Drew, one of our financial advisors, to be able to help you become an even better steward of all of your resources. Remember, this is free. We're not trying to force our services on you or try to do some kind of veiled sales pitch. Our mission as an organization, our mission as a podcast, is to help Christians become even better stewards. And while listening to us, we are confident that you'll become an even better steward by listening and applying some of the principles. The actual one-on-one interaction and allowing you to interact with the actual facts and figures of your life will do all that much more to help you be an even better steward. So go to stewardologypodcast.com/review to schedule your free review today.
Awesome. Now, this parable of the talents that we're looking at here has a connection to interest rates here as we look at the third steward that's there. And specifically today, we're going to be looking at interest rates, and we're going to be looking at three key areas of interest rates. And the impact that the interest rate has when it's going up and down. We're going to be looking at debt, savings, and investments. We will be examining the potential impact of these interest rate changes as we're seeing in the world today.
Yeah, what we're going to be doing is we're going to be addressing the question, so what should I do about it, and how should I think about it?
Yeah. So let's jump right into our discussion here. And the first one we want to look at is debt. And debt would include mortgage, student loan, credit cards, loans, and things like that. There's two types of debt that all subcategories fit into. They're fixed rate and adjustable. Now, Tim, I know you were into banking prior to being a financial advisor. So with that in mind, why don't you talk a little bit about these fixed rate loans and expand on that for us?
Well, yeah, a fixed rate loan is a very simple, typically it's viewed as a conventional loan where I would borrow a specific...
Is that synonymous, fixed rate and conventional? Can you use that term interchangeably?
Not necessarily.
Okay.
You can have a non-conventional loan that's still fixed rate.
Okay.
And that gets into more nuance than I think we need to be. Yeah. But the idea here is that you would borrow a specific amount of money. Let's say it's $20,000. You're going to pay back over a certain period of time, let's say 5 years. That'd be 60 months. So there'd be 60 payments. So you take $20,000 multiplied by an interest rate. That interest rate is not going to change throughout the life of the loan, and it's fixed at the date of the application typically, or depending if there's extraordinary circumstances, the rate may be adjusted to the rate at closing, whenever that happens to be.
Okay.
But at closing, let's say the rate is 5% and interest rates subsequently go up to 10%, you're still paying back at 5% for the next 60 months.
That's
fixed. Very simple, fixed payments. Your payments never change. They never go up. They never go down. You just pay that normal loan.
So our second thought kind of with this, that's kind of like the purpose and the mechanics. So when interest rates change, you're locked in.
Yeah. The interest rate adjustments don't affect you, your budget, or your loan.
So what are some of the pros and cons of these fixed rate loans?
Well, I mean, the biggest pro is that there's consistency. I can plan and anticipate what my budget's going to be tomorrow, next month, and next year because I know what the interest rate's going to be. There's something called an amortization schedule. An amortized loan is a loan that we can look at a table and say exactly how much principal and interest am I paying this month, and then next year, and in 3 years from now, you'll notice that the amount of principal each payment goes up and the amount of interest payment each month goes down. It's a normal amortized loan. It's predictable, it's steady, and it's easy to predict.
What are some of the cons?
Well, I mean, if you get the loan out during a high interest rate period of time, you're going to be stuck with that for a long period of time. So let me tell you, when my wife and I bought the house we currently are living in, interest rates were around 3%, 3.5%. And this was in between 2008. Well, we ended up buying the house in 2014. And during that time frame, Ben Bernanke was the Fed chair, and he came and he was going to start doing quantitative easing. And they announced quantitative easing, and maybe it was quantitative easing, maybe it was something else. I forget exactly what it was. I went and saw the house, and on the way back to the office, we were going to put an offer in. We hadn't locked in our mortgage rate yet. I was listening to the radio. Ben Bernanke does whatever he does, and mortgage rates spike.
Oh.
So we had to lock in that high interest rate mortgage. And again, relatively speaking, it was 4.75 which is not a terrible, historically speaking, not a terrible interest rate.
But just higher than
but
what
it was. Like a lot higher than what it should have been had we made an agreement earlier that day and locked in that rate earlier that day.
Wow.
So because of that, we got stuck with a 30-year mortgage that was a good, in some cases, almost 2% higher than what it could have been otherwise. Mm-hmm. Now, the advantage of this kind of loan is that you are able to refinance it without prepayment penalties or any issues like that. So we did refinance and got into a 15-year for 1.9.
Nice.
1.9? No, 2.9.
Yeah, I was going to say
2.9.
That's still very good.
It was a very good interest rate. Yeah.
So any other cons that you have there?
Yeah, there are not many because it's very predictable. The biggest con is if you get stuck with a high interest rate loan, or I guess another con would be there's no flexibility with the payment. If you lose your job or become disabled, or maybe your company goes, you go through COVID and you're out of work for a period of time through no fault of your own, that mortgage still needs to be paid the exact same amount. You have no flexibility unless the government steps in and does one of their government programs, has no flexibility to reduce your payment.
Yeah.
And that can lead to problems, potential foreclosures, and things like that.
Yeah. So since we're under this umbrella of debt, let's take a look at another form of debt, adjustable rate loans.
I mean, the opposite of a fixed rate is adjustable. So if you have a fixed interest rate for a very specified period of time, and now you have an adjustable rate one, you've got one where you don't have the predictability. It's based on whatever the prevailing interest rates are. As they go up, your interest rate goes up. As they go down, your interest rate goes down.
So what would be the good purpose for one of these?
Well, there are a number of benefits typically that an adjustable rate type of a loan would give you. If you're comparing a fixed rate loan versus an adjustable rate loan, oftentimes you'll find the adjustable rate interest rate, the initial interest rate, lower than the fixed rate. So you may be attracted to take that lower rate, but not be aware or maybe cognizant of the risk that rising interest rates may really impact your ability to repay, because your monthly payment you've budgeted out at that low interest rate, but now has gone much higher.
What kind of loans encompass these adjustable rate loans? What do we have here?
There are a lot of sub-varieties within here. I mean, one of the simple ones would be like a home equity line of credit.
Yes.
Right?
Yeah.
Or you could even look at something like a credit card.
Okay.
These are things that are, the interest rate will change from time to time. Oftentimes with your credit card, you're amortized. They're basically creating a payment schedule to get you paid off in 15 years or more, depends on the card and what you're doing. And the interest rates are really high. You don't typically see those show a drop in interest rates when rates drop precipitously, but you will see them go up when interest rates go up. So,
and very quickly.
Yeah, you got all the bad with not a lot of good with credit cards. So be aware of that. Home equity lines of credit, you have that. You're paying back that monthly payment. Your amount of payment is going to increase or decrease based on that interest rate. But you also have to recognize there's another variant of this called an interest only arm or adjustable rate loan.
I don't know anything about that.
So an interest only would be the only payment that you are required to make for the first, let's say 5 or 10 years is an interest payment. So you borrow, let's say on a home equity line, you borrow $100,000. You pay interest. So 6% times $100,000 is X number of dollars. You pay that per year. And at the end of the year, at the end of the 5 or 10 years, you still owe $100,000. If you haven't made any extra principal payments, you still owe $100,000. And there's a required balloon payment, or they convert to a 15-year normal interest and principal loan.
Interesting.
So there are a couple ways that those can go. Those are dangerous because if you're choosing that adjustable rate mortgage because you know for a fact you're going to sell that home and refinance it or cash out or do something else within that 5-year period, and then something changes, and you can't. Maybe the market moves against you, your health moves against you, you lose your job, can't get a new mortgage. You're going to be up a creek without a paddle because your principal balance is not decreasing.
Yeah, that is a big challenge. So let's do a little concising, if that's a good word, of the pros and cons. Summarize.
Let's summarize.
Summarize of the pros and cons of ARMs.
Well, so ARM is different. Adjustable rate loan is different than adjustable rate mortgage, ARM.
Okay.
So an adjustable rate mortgage is more formally a mortgage tied to a house.
Correct.
They're more protections and limitations. So they allow you a lower interest rate than a fixed rate mortgage. Their lower rate means that you'll be able to pay more principal every month, theoretically, which is a goal.
That's a good thing.
Yeah. And theoretically, rates could go down unless you're getting it today and we have rates going up.
Right.
On the negative side, with an adjustable rate mortgage, rates can rise over time, and they are right now.
Yes.
Certain caps can cause negative amortization. So again, what this basically means is that you could, if your interest rate is capped and they aren't going to make you pay more, but the actual effective rate is higher, you could actually see your balance increase on these loans if you're not careful.
Yeah.
So you have to be aware of these things. Your monthly payments are going to fluctuate, and you don't know what your financial situation is going to be. If it's going to change when the rates go up and you have less ability to pay that loan or that mortgage, that's going to be a problem.
Yeah. So would you say that when you go for something that's an adjustable rate, and I hate this term, I'm going to use it anyways, but you're betting that the rates are going to stay low for your purposes?
Yeah, you're betting they're going to stay low or they're going to go down.
Yeah.
You don't ever really want to get into an ARM or an adjustable rate scenario with interest rates on the rise.
Yeah. What a challenge. What a challenge. So, Tim, what would be like a good scenario? Give us a scenario or two.
I want to get a mortgage. Interest rates have been rising. What should I do? Here's your scenario.
Especially in today's arena right now, people are being challenged because the interest rates are going up and the housing market is a challenge still.
Well, I would just point this back to the previous episode that we recorded on trying to buy a mortgage in this or trying to buy a house, get a mortgage in this kind of environment. You have to balance out the budgetary need to not spend more on housing than you can afford versus your need to get an interest rate that is manageable and affordable. If you believe interest rates will eventually drop, you can get a mortgage now and hope to refinance it. But the problem is there's no guarantee that interest rates are going to go down.
Yeah.
And you may be stuck with that high interest rate for a long period of time. So you have to be either bringing more to the table to get your monthly mortgage payment down to a rate that you can afford, or you have to look for a smaller size house.
Yeah. Yeah. So what about this scenario? I have an adjustable rate mortgage and interest rates have increased. Yeah. My back's up against the wall. What do I do?
I've been telling people for the last 5 years, if you have adjustable rate home equity lines of credit or adjustable rate mortgages, look to refinance it at today's low rates. Of course, they're not quite so low anymore. Yeah. Lock it in. Lock that interest rate in if you're able to. That way, at least it's predictable.
So let's take a shift. We've now talked about basically debt. Let's shift over to savings. And savings would include your savings account, your checking account, money market accounts. Tim, explain some of these pieces. And there's other nuances in there also.
A savings account is a non-transaction account. So this is not an account that you are doing payments out of or taking money into on a general basis. You're allowed by law to do 6 transactions, debits a month out of a savings account. It's a legal requirement. And if you go above that, the bank may be forced to charge you a fee or maybe even remove the interest-bearing feature from that account.
Wow.
So savings accounts, money market accounts are not designed to be a checking account. You aren't supposed to do all the debit card transactions and all of that. If you go to the bank, your local brick and mortar bank is likely going to be offering you next to zero savings or interest rates on your savings accounts, money market accounts. If you go to an online bank, I'll give you a couple examples. It's not an endorsement per se, but Ally.com, that's personally where I happen to have my savings account, or Capital One 360.
That's where I have my savings account.
Yeah. Or Live Oak Bank. There are a number of others out there. They're FDIC insured online savings accounts that pay a high yield, a relatively speaking high yield on that money. So my account right now is earning 1% a year, and it's got no minimum account sizes and no minimum required balances, no fees. It's really simple. You get 1%. And as interest rates go up, that interest rate will go and reflect that.
And we've seen that this year.
Yeah. So it's just something to be aware of. It's an option. I think it's a smart option, especially in light of what we're talking about with you should at least put the money at the bank to get interest, or usury, I think is what Jesus said.
Yeah.
That at my coming, I could have got my principal back with the interest. Well, yeah, I would argue putting some of your emergency funds that you don't want to take a lot of risk with and get a little bit of interest rate through a high yield savings account would be a wise move.
Are there any other pros and cons of these savings, checking accounts, money market accounts? What are some pros, and also what are some cons there, Tim?
So if you have a high yield savings account, typically, like for me, it's at a different bank than my checking account's at. I have to give myself maybe 2 or 3 days before I know the money will be available in my checking account to ready to check out of. So I have to go online, transfer money from account A to account B. That money gets direct deposited to my checking account, and there may be a delay of a day or 2 or 3.
Right.
So you have to simply be aware of that. It's not as fast as going from the same bank savings account to checking account where the money's available instantaneously. So if you're looking to, if you write out a check you forgot about, and you need to float that payment by pulling money over from your savings account, you may want to make sure you have reserves.
Good point.
Over at your local bank that can handle that.
Yeah. So very good point.
It's FDIC insured, which is helpful. They're both FDIC insured.
Explain what FDIC means, because some people, they see it, they hear it all the time.
Federal Deposit Insurance Corporation, FDIC. Basically what it means is that if the bank goes belly up, the government's going to back you up to $250,000 per account registration.
Nice.
Per bank. So if you have $100,000 at the bank and the bank goes belly up, the government, the FDIC, the Federal Insurance Deposit Corporation, FD, Federal Deposit Insurance Corporation,
Gotta get them right.
will write you a check for what you lost.
Yeah.
If you had $500,000 at that bank in one account, they'd write you a check for $250,000.
Right.
If, however, you broke that up into two $250,000 accounts, one at Bank A and one at Bank B, then you have full coverage.
Gotcha. It's good to know that. So we talked about savings and checkings and money market accounts. Let's do a little bit of a nuance there. There's something called CDs, Tim. Explain that what this is and what kind of types are out there.
Yeah, a CD is a certificate of deposit. We jokingly like to call them certificates of depreciation. We do that because interest rates on CDs have been really lousy and certainly lower than the inflation rate. Well, that's certainly the case today. In a CD, I put my money in an account that I am then restricted from touching for a specified period of time. So if I get a 3-month CD or a 6-month CD or a 12-month CD, that's 3, 6, or 12 months that I can't touch that money. But in exchange for locking it up for that certain period of time, I'm going to get an incrementally higher interest rate theoretically by choosing that time frame.
And am I right in saying that the longer you, using your term you just said, lock it up, the better rate you get?
Typically. Not always the case, but yes.
Okay.
Yeah, CDs are I'm finding right now that you can use a high yield savings account, get about the same interest rate without any of the time frame lockups.
Nice.
No minimum account sizes. It's simpler. So I don't really see why anyone would want to go and lock their money up for a period of time when they get the exact same interest rate or a similar interest rate with no lockups.
Tim, I've heard of a variable rate CD. Explain that.
Well, a variable rate CD is a CD that's interest rate adjusts based on the prime rate. So the prime rate is it's based on the federal funds rate. So the Fed, the government, the Federal Reserve sets the Fed rate, which is an interbank loan rate, the rate banks charge other banks to lend money to other banks. And based on that rate, the prime rate is established. And so they are going to see the interest rate on the CD adjust anytime the Fed increases rates or decreases rates. You may see your interest bearing nature of that account go up or go down based on what happens with the Fed change.
And I saw another type of CD called a no penalty or liquid CD. How does that work?
Again, these are different ways, strategies that banks are using to incentivize people to give them those CDs, those deposits, and not have some of the lockup frameworks and the penalties if you break it early. You can also get, I think the next thing you have on your list is a brokered CD.
Yeah.
And they're similar in some respects to this no penalty or a liquid CD. Because with a brokered CD, I would go to an investment account, like an account at your financial advisors. He would go to the market and find, let's say, Sally Bank is selling a $10,000 2% CD for 5 years. You buy that, and let's say next month you find that another bank, First National Bank is offering a 3% 2-year. Well, you can sell your 2-year CD at Sally Bank and buy the 3% CD at First National Bank. But the difference is that there's no penalty, but you have to pay the prevailing rate. Whatever the market would pay for that is what you would get for it. So if interest rates have gone up in that 1 month intervening, then the relative value of your CD has decreased some.
Right.
We talked about that in a previous episode with what's going on with the bond market. That kind of does a better job of explaining the relationship between interest rates and prices of things like CDs and bonds.
So what would be the purpose of having a bond of a CD, I mean?
Purpose is that it's FDIC insured. You typically get a higher interest rate than you would get in a savings account, and that you're not taking any risk with it. You're getting some reasonable return, quote unquote reasonable. The last couple of years has not been that reasonable,
right?
And you're not getting that risk.
So somebody has some CDs. They're coming close to maturity right now. Tim, what are your thoughts? How would you counsel someone that way?
So many different variables. What's the interest rate in which they're going to renew? Because CDs automatically renew if you don't do something.
I had no idea.
Yeah, no, CD automatically renew. So if you get a 5-year CD at 2% and interest rates have gone up, you're going to get whatever the new 5-year prevailing rate is. You'll have a window of time. 30 days typically.
Okay.
Maybe 15 days from the date of prior to and after the date of maturity to make any changes, to pull the money out or do whatever. And if you don't, it's going to automatically roll in and lock into a new 5-year period.
Interesting. I did not know that.
And then
was automatic.
The new penalty will apply.
Okay.
So you have to be aware of that. What was the question again? I'm now losing track of my thought process.
The question is, my CD is about to renew.
Oh, what do I do? Gotcha.
What should I do?
Yeah. So what's the new interest rate? Be aware of that. What's the time frame? If your time frame has changed, you don't have 5 years now, but the new CD is 5 years, then yeah, you definitely want to make a change. My general recommendation to folks is that, pull it out of the CD, use a high yield savings account. You get about the same interest rate with none of the lockups. And the benefit of his interest rates go up, your interest rate on the savings account goes up.
Nice.
So that tends to be a better option. And if there's more cash there than you really need, Sometimes it may actually make sense to use that to do some investing, to purchase things while they're on sale. So again, so many different variables.
Now, Tim, I grew up and I saw a lot of what they call double E bonds, and I've owned a few through the years. What are they? What's the purpose of them?
Well, they're government bonds. They're terrible. I can't stand them. They're horrible.
Tim, tell us how you feel.
I used to sell them to folks or help them get them when I was at the bank. It used to be that they were adjustable rate. Like you would, as interest rate goes up, you get a better rate. As interest rates go down, the rate you receive go down. These are the bonds where you buy $100 bond, but you only pay $50 for it. And over time, it accumulates interest and grows to that, that face amount.
Right.
The problem is, you know what the interest rate today is on that stupid EE bond?
I have no idea.
0.1.
Ouch.
0.1%.
Run.
Don't do it. They're bad. So I really have no love for these bonds. And now, guess what? That's fixed. That's fixed for the term of that loan. You might as well just put it in cash.
If the audience could see your face right now, Tim.
It makes no sense. Like, government, what are you thinking? This is a terrible instrument. There is one guarantee that an EE bond will do, even if its interest rate is 0.1. They guarantee that it will double in 10 years. Or not 10 years, 20 years. It will double in 20 years if you don't touch it. So you have to wait for 20 years. But if you leave it for more than 30 years, you get no more interest.
Interesting.
Interest stops bearing after 30 years.
What is an I bond?
So an I bond is a bond offered by the U.S. government that has its interest rate tied to inflation.
So is that why they call it I bond, like an inflation bond?
Yeah.
Okay, good.
It's similar. I've never been a fan of I bonds. Well, it's designed to help insulate you from the inflation risk.
Okay.
I've never been a fan of I bonds. They're not, frankly, that great. However, right now, they're providing a very compelling offer. The interest rate, because of inflation right now, the interest rate's actually annualized 9.62%.
Really?
9.62%.
Where else can you get that?
Well, certainly not in the stock market today, if you've looked recently. I'm not saying that individuals should take all their money out of the market and buy I bonds. In fact, I actually think that would be a terrible idea. But for individuals who have money that they don't anticipate needing for the next several years, the use of an I bond might be a very interesting option. Here's what you need to know. The I bonds have 6-month interest rates.
Okay.
So the current 6-month interest rate is, see if I can find it. It's basically half of 9.62. So if you put the money in for 6 months, you get that 4 point whatever.
Right.
And if 4.8 or whatever the number is, and if you leave it in for another 6 months, then you are essentially theoretically possibly getting up that 9.6%. Now, the trick is every 6 months, the interest rate will adjust. It will go up or it will go down or it will remain the same.
Okay.
So you're gambling that interest rates will at least stay the same or go higher. I would say based in today's market, that's a likely scenario. Not a guarantee, but it's a likely scenario.
Right.
And if you leave it for at least a year, you can pull your money out without any penalties.
Okay. So so a year, no penalty. 6 months, if you pull it, you'll have some penalty, correct?
Yeah.
Okay.
Yeah. You can't redeem it within 6 months.
Okay.
You can't redeem it within 6 months.
So it's a minimum.
You can redeem it after 1 year.
Okay.
But here's the catch. If you redeem it and you've held it for less than 5 years, you will simply give up 3 months of interest. So that would be like accepting a 6 point whatever percent return rather than a 9 point whatever percent return.
But still,
it's not the end of the world.
Still, that's not bad.
No. By no means is that a bad thing. After 5 years, if you hold it for 5 years, there's zero penalty. So there's a 3-month penalty if you give it up within 5 years of owning it.
Okay. So what other pros and cons can we learn about I bonds?
Well, $10,000 per person max.
Maximum per person.
Yes. Now, but you can every 6 months you can buy a new 10,000.
So you can have multiple 10,000s.
But you have to do it in each new term.
Oh, okay.
So I couldn't go and put $100,000 into I-bonds today. I could do $10,000 in my name. I could do $10,000 in my wife's name, and I'm guessing maybe I could do $10,000 in joint. I don't know, but that would be 3 different registrations, getting 3 different rates. Again, don't quote me on the joint. I'd have to double check to make sure that's available. That's one option. Or I could do $10,000 for me and my wife, and then in 6 months I could do another $10,000 for me and my wife. But again, that starts a brand new holding period for that second bond.
Sure.
They all
the
have to
5-year
be
window
held for
kicks
at
in.
least a minimum of a year, and to avoid penalties, hold it for at least 5 years.
So,
and this is not a recommendation to go and buy them, but this is just, hey, FYI, these things exist.
Now, I'll be honest, this is something new that I've learned within the past few months. I've heard some of the team members here talk about them. If someone's interested in doing it, how do they go about getting one?
Well, the only way to do it is to go to treasurydirect.gov and buy it direct from the government.
There you go. So taking a look at this when we're talking about these interest rates in light of some of the banking stuff and specifically looking at savings. Tim, let's look at a couple scenarios. My bank isn't offering really good interest rates right now. What should I do? What would you say?
Go online, go to bankrate.com, look up savings accounts, look at the high interest rate savings accounts around you, and pick one that you like. Beware of ones that are paying ridiculously high interest rates that just aren't justified by competition or the market. I think there was one out there that was paying something like 3%.
Yeah.
I would avoid that right now.
Yeah, I brought that to your attention, and you got into some of the fine print of that, and it was not.
Oh yeah. There were lots of like little red flags. Like you can't put more than this certain amount of money in there, and a bunch of other things that were happening that I'm like, this is a fly by night organization just trying to gather assets and hopefully become a player.
And I didn't think it was secured at all.
Yeah, I forget.
I think that was one of the hiccups there. So what about this one?
Yeah, make sure they're FDIC insured. That's the one thing.
Important. There's a young couple. They have money for a house down payment. They're not going to be using for a few years. What's a good use of that money right now?
Well, I mean, if they know that for sure that they're not going to hold it, they're not going to do anything with it for the next couple of years, then probably doing something like an I-bond would make sense. As long as they're willing to part with 3 months of interest if they pull it out less than 5 years.
Sure.
But there's no guarantee that the interest rates are going to stay at this level. They could go higher, they could go lower.
Right. So let's take that same scenario. Somebody has a car replacement fund and that they've been putting into over and over, and they're not looking at seeing it for the next 2 to 4, maybe 5 years to replace their car. What savings arena do you think would be wise for that?
High yield savings account can make sense, or using something like a I-bond again. That may be a viable option.
Okay, let's do a shift over to investing.
The one downside with the I-bond is that I wouldn't do monthly contributions or purchases into them because they would be different bonds every single time.
Yeah, that would be
a challenge. It becomes very cumbersome.
Yeah. So let's take a look at investing. Investing, we did a whole episode on bonds. So let's kind of do a little summarization there and talk about that. Bonds and interest rates. Talk about that, Tim.
Well, again, refer to the other episode, but the interest rates as they go up in the market, they're generally bad for bonds. So be aware of that. How do interest rates affect investing? They can cause problems with the stock market. They can cause problems with the bond market. Right now, they are raising interest rates, which generally would drive people to stocks, but stocks are currently falling because they're also stopping quantitative easing. Again, refer to the previous episode where we talked about what's going on with the bond market. And we're seeing interest rates are going up, affecting the value of older bonds. Remember when I was talking about CDs earlier? If you bought a CD for 2% and the next month the CD was at 3%, remember that? Mm-hmm. If you wanted to sell that 2% bond after interest rates rose by 1%, you would take a haircut on that 2% bond, because who in their right mind would buy your lousy 2% bond when they can go out and buy a 3% bond or CD in the illustration that we used earlier today? So there are impacts. As interest rates on new bonds go up, older bonds look that much less attractive.
Yeah. So what are some different types of bonds that are out there, Tim?
Well, there are lots. This is not by any stretch designed to be an exhaustive list, but Treasury inflation protected securities, TIPS. These are bonds that have adjustable rate interest that adjust with inflation. As inflation goes up, these bonds tend to go up. There are U.S. government debt, so government loans, government debt, government bonds. They're generally considered the safest and lowest yielding, lowest interest rate. You've got investment grade bonds, got core bonds or things that are called core plus that are a little bit more risky, may have a little bit more upside. And then you have international bonds. Those are ones that are problems right now with interest rates and currency rates. There are a lot of reasons why international bonds are probably to be avoided today.
So what are some of the pros and cons?
But you also have high yield bonds. And high yield bond would be a company whose finances are perhaps not quite as robust as the U.S. economy or the U.S. government. So therefore, you're going to pay a much higher interest rate. They're going to be more sensitive to market volatility. As the market struggles, high yield bonds are going to struggle.
So let's look at some pros and cons of investing in bonds. What would you see some of the pros be?
Historically, one of the biggest pros is price stability within a portfolio. If you are invested in the S&P 500 and you see the S&P 500 drop by 50%, that is a huge drop. But what if you're 60-40, 60 S&P 500 and 40 bonds? Historically, what you see is your drawdown decreases from something like 50 to maybe 30. 30 is still a huge number, but that's a 20% less than 50. And that's not a guarantee. This is just an example. But historically, bonds tend to insulate a portfolio against market losses. They also provide regular streams of income. Those monthly interest payments or dividends are really helpful, providing cash flow and money that people can live on in retirement. They tend to be less risky than stocks. Not only do they help avoid big market downturns, they're also just generally less risky. And bonds have clear ratings. So you can go and you can see, is this a safe bond or a risky bond based on its credit rating or its they have these organizations that go out and look at the financial health and well-being of a company and then give a grade for those bonds. There could be something like AAA that's safe, the safest you can get, like U.S. government debt.
I've heard that. Or
they could be so risky as to be not even get a rating. It's like below an F,
wow.
For example.
Wow.
And they don't rate them on an A through F like a high school grading scale, but it would be like a failing grade.
Sure.
So there'd be high yield. So double B, single B, these would all be high risk bonds.
So what are some cons? We just talked about the pros of these bonds. What are some of the cons?
Well, they're very sensitive to interest rate. As interest rates adjust, you're going to have problems with your valuations. So be aware of that. Large sum investors need bonds. So if you are looking to purchase, let's say $100,000 in bonds, you aren't going to want to go buy an I bond or an E bond just because A, you can't,
right, and
B, it would just be really cumbersome to have that much bonds in these little 1Z, 2Z, 3Z things that you have to manage at treasurydirect.gov. It's a lot more cumbersome to try to deal with. There's some liquidity issues. If you have a bond and no one wants to be on the other side of that bond and wants to take it from you, you can have an issue if
you're
there's a
kind of stuck with
crisis.
it for a while.
Yeah. So, again, we talked about interest rate risk. So those are the biggest cons.
So let's shift out of this savings idea and let's look at the stock market. What is the overall impact of rising interest rates on the stock markets, on investments, the stocks, bonds, et cetera? What do you have, Tim?
Earlier I mentioned that rising interest rates right now, they are affecting the stock market. Stocks are going down and bonds are going down. Historically speaking, as interest rates rise, stocks are generally doing okay. They're doing okay because they're rising the interest rate. They're increasing the Fed is increasing the interest rate in order to start to slow down the economy. But generally speaking, the economy is already doing pretty well at that point. Mm-hmm. And they can shrug off those interest rate hikes for a while. So there's not a direct one-to-one correlation with interest rates and the stock market. There are a lot of other factors that are going to impact how the stock market does.
So we just talked about interest rates as a whole on various different arenas of finances. Let's kind of wrap this up, and I want to kind of take us back to where we started in the beginning. When deciding where to put your extra money, it's a good idea to think about how it ties to your overall financial plan. Having a plan in place will provide you clarity to manage your money, and you'll be thankful for not only now, but also in the future as you kind of put that plan together. That's why we offer these personal stewardship reviews. And we want to encourage you, think about that, because if you do have some extra cash laying around, we can give you some advice on where it could go and maybe what you should be doing with that. When coming up with a plan, consider seeking that expert advice. And again, go to stewardologypodcast.com/review. We'd be more than glad to talk about some specialized areas that you can take and put that extra cash that you have right now, if you have that. Now, back to the opening verses in the parable of the talents. In the whole of this passage, it's a good reminder that there is a responsibility that's been put on us as stewards of God's money, of God's resources. And remember what we see in this passage of Scripture, that here, these first two servants, the one that got the 5 talents, the one that got the 2 talents, they doubled it. This is what the master said to him. Exactly. He says, the master replied, "Well done, good and faithful servant. You have been faithful with a few things. I'm going to put you in charge of many things. Come and share in your master's happiness." And then the servant that hid his talent, this is what the master said to him. "So take the bag of gold from him and give it to the one who has 10 bags, and throw that worthless servant outside into the darkness where there will be weeping and gnashing of teeth." Then the master stated the rewards for that faithful servant. "For whoever has been given more, and they will have an abundance. Whoever does not have, even what they have will be taken from them." That's some pretty harsh words that are there. So which of these 3 servants are you when it comes to your personal stewardship of what God has placed into your care? A very basic, rudimentary, simplistic thing as a point of application of what we're talking about here with interest rates is checking the interest rate on your savings account, on your checking account, and maybe make some adjustments to a different bank in town. To, as Tim said, there's a couple online bank accounts that are FDI insured that you could jump your money on over to and park it there. Or it may be even something more extensive, as we talked about earlier on in this episode. A simple move of your finances to even a higher yield interest account is probably one of the very basic and simple steps that one could do to begin that journey of being a faithful steward. So we want to encourage you to think about, where are you in this process of stewardship, and consider if maybe you don't have the thousands of dollars to do things with. Maybe your next step or your first step would be just checking the interest rates in town, checking the interest rates online, and making an adjustment so that with what you have, you can be an even better steward of what God has put into your care.
Well, thank you for joining us today in this episode of the Stewardology Podcast. Please leave ideas, comments, and thoughts for us at stewardologypodcast.com/ideas. Don't forget to take advantage of your free stewardship review at stewardologypodcast.com/reviews. And please, 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 please leave reviews, comments in your podcast catcher, as they are very helpful in helping others find this podcast. Thanks so much. Take care. God bless. And don't forget to check out high yield savings accounts that are FDIC insured.
Thank you for joining us on the Stewardology Podcast, where financial stewardship and theology meet. We'd like to help you take your next steps in biblical financial stewardship. First, subscribe in your podcast provider to get the newest episode delivered to you every week. Next, follow us on social media and visit our website at stewardologypodcast.com. There you can find our social media links and our entire episode archive. Remember, some trust in chariots and some trust in horses, but we trust in the name of the Lord our God. See you next week on the Stewardology Podcast. Securities and advisory services offered through Genius Wealth Management, member FINRA and SIPC.